What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the GDP numbers that came out, the jobless claims numbers, interest rate expectations, and more importantly, the 20-year bond auction that took place yesterday, which of course is driving the yields lower once again, and the markets are recovering back higher. As always, if you enjoyed this video, all I'm asking in return is that you, of course, drop a like and subscribe to the channel if you haven't already. I would really appreciate that. It helps grow the channel significantly, so I really appreciate each and every one of you. And links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available until the end of December. And definitely do check out our big sale for Christmas. Coupon code Santa Rally, because we are in a Santa rally, and you can get access to all the individual courses or bundles that are going to be 50 to 60% off. And again, do check out the links down below for lifetime access to these courses. And this sale does expire after Christmas. So again, links going to be down below, and we'd love to have you on board. So this right here were the GDP numbers. Came in a little bit lower than what the expectations were. So we came in at 4.9% on an annual basis. This was, by the way, for the third quarter 2023. The consensus was 5.2%, so we came in about 30 basis points lower than what the expectations were, and also came in on the lower end, in fact, lower than the lower end of the consensus range for GDP as well. And when it comes to jobless claims, slightly higher than what the consensus, actually the previous revised number was, and the consensus was 210,000. So a little bit lower than the overall consensus here, but of course slightly higher than the prior revised number as well. So far we've gotten two indicators on an economic basis that once again kind of reaffirm that the economic growth is slightly slower than what the expectations were. Jobless claims were slightly higher than what the previous number was. And then if you take a look at the bond auction, it actually does suggest pretty strong demand for the 20-year bond auction as well. So if you take a look at the total amount that was being raised, about $13 billion, the coupon rate was 4.75%, and the yield awarded was 4.213%. And this right here, this is the most important metric when you're looking at bond auctions. Very, very important number to cover, bid cover, right? This basically means bid to cover ratio. And this ratio will be a number anywhere between like 0 to as much as could be 5, 6, but the average has been around 2.5, and this number was a little bit over 2.55. Now, this definitely means there was what? Very, very strong demand for these bonds. As a result, the yield awarded was obviously lower than the actual coupon rate. Now, one more thing I want to mention is 2.55 simply means how many times over did the investors subscribe to in terms of dollar amount versus the amount being raised. In other words, 2.55 is simply telling us 13 billion times 2.55 is roughly going to be 30 billion. 30 billion is what came into the market subscribing for this bond, and 2.55, of course, is 2 times higher than the amount being raised, 2.5 times higher than the amount being raised. So there was significant demand for this bond auction, which again is going to do what? Drive prices higher, yields lower. And as a result, we do have the 10-year yield at 3.86, so it's again sub 3.9%, and the 20-year is also down 4.17, so sub 4.2% as well. It's been selling off pretty aggressively from its highs of well over 5.3 from back in October. It is down a little bit over 22% as well. Now, if you take a look at the market's expectations, so CME Fed Watch tool, we are now pricing in 1, 2, 3, 4, 5, 6. 6 rate cuts is what the market's pricing in. Of course, 5.25 and 5.5% is where we currently are. And the market's expecting for rate cuts beginning in March all the way through December of next year. So every single meeting next year, the market's pricing in rate cuts of 25 basis points each. So every single one of them is going to be 25 bips of basis points, basically cuts from the Federal Reserve moving forward. So that's really where the expectations are from the market. Of course, we'll find out eventually if that is going to indeed be correct or not. In other words, the Federal Reserve's penciled in 3 rate cuts, and the market's pricing in 6. So that obviously is a discrepancy between what the Federal Reserve is telling us versus what the market's pricing in. So there is a little bit of that repricing risk from the market, as I've already mentioned in my previous videos. But at the end of the day, the Federal Reserve is more than likely to kind of come around the market's expectations if A, there is any type of recession risk. So if there is any weakness in the economy, unemployment starts to go up, there is going to be some more alignment from the Federal Reserve standpoint to come in line with the market's expectation of interest rates. Or B, if there's any type of deflation risk in the economy. So far, we haven't seen that because prices have continued to go higher. There's, of course, bigger stagflation risk than there is deflation risk. But of course, we've heard from Jeremy Siegel, Kathy Wood, a lot of folks from an economic standpoint suggesting there's possibility for a deflation, but we haven't seen that, except only on energy side. Oil prices have been lower from same time last year, but everything else is still higher compared to last year as well. So of course, the markets have obviously been very, very vulnerable to a lot of economic reports, but they've just been drifting higher and higher. This right here is from 21 hours ago. The 20-year bond auction drew a high yield of 4.213% and a bid to cover ratio of 2.55, which I covered earlier. So of course, there was somewhat decent demand for the auction that we had for the bond market, which of course is driving the yields lower and bond prices once again a little bit higher again. Now, I've also mentioned there is an element of that panic buying, because if investors, capital allocators kind of see these yields and then they understand the fact that they're down 20%, 22% from their recent highs, they're going to want to lock in these yields as quickly as possible to kind of fix them for the next 10 to 20 years, because everyone's playing a different game, right? You and I might be playing a game to generate alpha and beat the market. Capital allocators on the biggest scale, when they're dealing with trillions of dollars in capital, when it comes to sovereign funds, endowment funds, pension funds, they're not looking to beat the market every year. They're just looking to beat inflation. And if they can beat inflation with a simple fixed income bond, whether it's a 10-year or 20-year, they're going to take that opportunity and they're going to lock in those rates. So that's what I mean by panic buying. And as a result, TMF, TLT, as we've already known, that was more of a tactical play. It has done incredibly well over the last several weeks. You can see that it has pushed higher very well from $81 up over 22%, as of course the bond market has continued to struggle, and of course yields have come down, and we're now approaching a very important resistance for the TLT ETF at $100 and $405. And of course, not to mention TMF has also done really well, up over 50 to 60% from its lows of back in $38 per share. So next resistance target is going to be $70, $71 per share for the 20-year Treasury bond ETF, leveraged ETF as well. So that's where we are. Of course, next year is going to be a very, very interesting year filled with a lot of excitement, political year. So two big elections in India and the United States coming up, recession expectations, markets already overbought, overextended, lots of potential profit taking with some rotation out of the overcrowded tech sector, maybe to other parts of the market in the first half of next year. So lots of stuff kind of brewing. So it's going to be a very exciting year, I have no doubt. But let me know your thoughts down in the comment section below. For now, I'm going to continue to kind of hedge my positions by selling calls, considering how overbought, overextended the markets currently are. And definitely do check out the courses down below with the coupon code Santa Rally that does expire after Christmas. Let me know your thoughts down in the comment section below. What do you think about the markets and of course interest rates, and what your expectations are going into next year for rate cuts in 2024. As always, happy investing. I'll see you all in the next video.